Hey, Professor Mike. What are we learning today?
Hey team, it's Professor Mike here to talk to you about, what are we talking about today? Depreciation, absolutely. I think you guys are really going to like this one. So, what is depreciation? Or, for those of you that love IFRS, amortization. Don't worry about it. If you're not interested, it's called depreciation. So, for assets that last more than one accounting period, and there are plenty of these, right? I mean, you know, cash, accounts receivable, that's usually a single accounting period, or less, hopefully. But what if you were to buy a car in your business or a piece of equipment that's going to last 10 years? Because of the matching principle, it wouldn't be fair to expense that item entirely in the first year because that wouldn't match the use of the item to the time period. It just wouldn't work. So depreciation is usually on physical assets. And what it does is it allows you to account for the use of that to generate your revenue, which is again why you're buying these assets, over that period of time. So if it's a physical asset, you can think of something like, again, it could be like a car or a piece of equipment, like a piece of machinery used in production, for example, right? Could be that. It could be a building, vehicles, there's lots of different things that are used up over more than one accounting period. But they can also be non-physical assets, things like patents or franchise agreements. What we're dealing with in this class, just about everything we deal with is going to be an actual physical asset. Makes sense, right? You want to match the use of that asset, have it expensed to the time period in which it was used to generate revenue. So how do you calculate depreciation? There's a few different ways. In our class, we're just going to use one, and it's called straight line depreciation. And that's calculated as asset cost minus residual value divided by estimated useful life. So what did you pay for it minus what you're going to get for it when you sell it, or at least what you think you could get for it when you sell it, and how long is it going to last? So for a car that you buy for $10,000, you're going to use it for 10 years, and it's going to be worth nothing at the end of those 10 years, you would expense $1,000 a year. Absolutely. And this is how it's calculated. So we're allocating those costs of those long-term assets to expense them over their useful lives. Makes a lot of sense. And that's depreciation in a nutshell, really. Let's do a quick example. On January the 1st, 2021, it's going to be a beautiful day. Everyone excited for 2021? I am. A company purchased a piece of equipment for $72,000 cash. The equipment is expected to have a useful life of 4 years, okay, and a residual value of $8,000. I'd like you, or us together, to record the transaction to buy the equipment and also to record that first year's depreciation. Now, before we do that, we need to calculate what the depreciation is going to be, right? If we go back, we can take a look at our calculating depreciation formula again, and that's going to be the cost minus the residual value divided by the estimated useful life. Well, for our problem here, the cost is $72,000 cash. The residual value is $8,000. That's what we think it's going to be worth after the 4 years, which is the useful life that we're going to have it. So we go 72,000 minus 8,000 divided by 4 equals $16,000 per year is what we're going to expense for depreciation. And that account is going to be called depreciation expense. Kind of makes sense, eh? All right, so let's bring up our old friend. Hello, the General Journal. Love the General Journal. We go way back, the journal and I. As we were talking about in a different session, I enjoy journaling, but that's a different thing. So we start off with the date. Now, this asset was purchased on January the 1st, 2021. So in the date for that initial entry, we're going to write January the 1st, 2021. Perfect. The account titles, well, we bought a piece of equipment. So that's going to be equipment, the asset that we're going to debit. And we paid cash for it. So we're going to credit cash, both to the tune of $72,000. Next up, we need to prepare our adjusting entry. And now we're going to have to think about this. Say, okay, so we use this up for the full year. When should we expense this? At the end of that year. So it's going to be December 31st for our date. The two accounts we're going to take a look at are going to be depreciation expense, right? And now we're going to add a new account. And it's a contra asset account, a little bit different. It's called accumulated depreciation equipment. So we're depreciating the equipment, but what we want to do, because on our balance sheet, when we get to those, we want to carry our equipment at cost, and then we want to have the net value after depreciation as well. And so this accumulated depreciation account will allow us to do that, instead of just booking the depreciation directly to the piece of equipment, and then we would have to go into the notes to figure out what we paid for it. So that's why we use this other account. Again, two accounts. One is depreciation expense. The other is accumulated depreciation equipment. Now, that contra asset account, you might be thinking, okay, well, that's going to go up, so I want to debit it, but that's not the case. Because it's a contra asset, because it decreases assets, you're actually going to credit this account. It's the only account in this entire course that's still in the asset area that you credit to increase, because it decreases overall assets. Now, if you can't remember this, you remember that you always, what are you going to do with expenses? You're going to debit them. So if you're going to debit the expense, you must credit accumulated depreciation. And here we go. We got debit depreciation expense, and we credit accumulated depreciation equipment. The amount is the amount we calculated before. That's 72,000 minus 8 over 4 is $16,000. And that's depreciation. I hope that helped. Thanks. Bye.